Today we're on the second half of chapter 13. Does anybody have any questions they encountered on the homework or anything they started to think about as the stock market started to crash a few days ago? At least some people think it did. Correct itself is another word. Questions on anything? People absolutely freak out when the stock market loses a few percentage points. Those are corrections. They happen. You can go back and look over 7 years. And I think with the exception of maybe 2019, the stock market's lost 10 percentage points, but come back most of the time. So a lot of what we're learning today, I want you guys to think about in terms of the bigger picture. And I keep mentioning this because it's really important. Sometimes we get so caught up on just getting that homework done or getting this quiz done. And we think short term, like, oh, I need these points for this grade. And what I want you to be thinking about also is the longer term. How can I use the information I'm learning in this class or any other class that you're taking to help me somehow outside of the classroom? Danya, I'm not going to put you on the spot, but I know people like Danya had their eyes open to some of the things that the stock market can provide. And after a class project last semester, got interested in the stock market and started to dabble around. I love hearing that. And it's not because I want you guys making money or losing money. It's just because I want to spark an academic curiosity in what is available out there to you in the hopes that you'll want to learn more about it outside of this classroom, which again is, just a drop in the bucket in your whole academic career. So any questions on that?
It's funny because when the stock market I see take a dip, I actually like, now I could go buy more.
Exactly.
So depending on how you see it,
Yeah, that is a longer term perspective comment, right? So people freak out. I was listening to some podcasts and listening to some people that were retired and were freaking out because they rely on their portfolio to generate retirement income. I totally get it. But if they studied the stock market, they would see that this is nothing radical that's happening. It's just it's a correction. And like Danya said, if you're prepared, that's when you can jump on the opportunities that present themselves when the stock market takes a dive. But you can only do that if you have the cash saved and available to take advantage of the discounted prices. So again, that's more of the bigger picture of this chapter. I think out of everything that we're learning, this chapter, along with the cost volume profit chapter that we'll be learning about, has the most relevancy to our personal financial lives, right? Most of us in here are not going to go out and work in process costing. And so, yeah, we had to remember those 4 steps for a test. This chapter, though, the ratios that we're going to be talking about and learning how to apply them. And the only way you get better at investing, just like I tell you guys, you got to practice the homework. The only way to get better at investing is to get your feet wet and learn the lessons. Sometimes they're expensive lessons, but if you learn how to read these ratios and you learn how to research other companies, you can mitigate the risk. You can't totally get rid of it, right? Because you're always going to have those companies like Sears that we never expect to go out of business, but you can mitigate it if you know what you're looking for. And that's why I would encourage you guys to take this chapter to heart and look at it in the longer term perspective. Any questions before I share my screen and we jump in today? Okay, then let me share my screen. And you can see I had Ford information on my screen there. I was looking at them. In fact, I just bought some Ford stock when the prices tanked. Okay, so today we're going to focus on these ratios. And what I'm looking at, it looks like, is page 4 out of 5 on the handout that's in the chapter 13 modules link. And yesterday we focused on liquidity and efficiency ratios. And liquidity means, do you have the financial wherewithal to pay your bills in the short term? That's what we were looking at. And we were looking at the current ratio, the acid test ratio, and then we were looking at some specific ratios related to receivables and to inventory turnovers. And the reason those fall under the liquidity and efficiency ratio category is because it focused on short-term assets and short-term or current liabilities. Today, we're going to take a look at longer-term ratios. So we're going to take a look at solvency ratios. We're going to take a look at profitability ratios. I think the solvency ratios, rather than relying on some boring book data, we're going to pull up a real life company. I'm going to use Ford because I was researching Ford quite a bit this week. Then we'll talk about, so solvency ratios is, do you have the financial wherewithal in the long term to keep the company running and to keep the company profitable? So that's what solvency looks at, the longer run, not just can you meet your bills next month, but over the longer term, does this company have what it needs to maintain that business in the long term? Now, why would that be important to someone that is looking to invest into a company? Because guess what? Most people don't know this. When a company goes belly up, when a company goes bankrupt, shareholders fall on the absolute last rung of the ladder of who gets paid first. So if a company goes bankrupt, creditors fall way up here, bondholders fall way up here, and shareholders fall dead last on that ladder. So the reason I would care about that if I were getting ready to invest in a company is because, of course, I don't want to lose my money knowing that I fall last. I want to make sure that everybody else who they owe money to can be paid off in the longer term. And so we have some ratios that can help us look at that. We'll take a look at profitability ratios. Profitability ratios, most of them have in common the fact that there's a net income factor in there someplace. In fact, anytime you see the word return, that's a profitability ratio because return refers to net income. And so these ratios measure the company's ability to generate a profit, because we know, and some of these large companies that we're looking at, they don't always generate a profit, right? I don't think COVID-19 was forecasted by too many people. And so these companies had to rely on their retained earnings to sustain themselves through these difficult times. But do they have the necessary history? Have they consistently generated a profit outside of these weird things that have come up in the past couple of years? Because if you're not profitable, you may be able to sustain it for a year, 2 years, 3 years, but that retained earnings is only enough to support you for so long. And so again, if you can't sustain a profit, that's not a good thing for investors. So investors look at profitability ratios. Any questions on those first three? And we're going to jump in, of course, in a minute. Right now, we're just summarizing. And then the next set are what we call market prospect. They're forward looking. They're based on future expectations. And as an investor, that's always key. Nobody has a crystal ball. We don't know for sure what companies are going to do in the future, but many times past history will help predict what's going to happen. And those are the price earnings ratio, which is the most heavily quoted ratio in all of Wall Street. So I would highlight that one, right? I never buy a stock without looking at the PE ratio, price earnings ratio. So we'll take a look at that. It is published every single day for every single publicly held company in the Wall Street Journal. So you could go look this up on a daily basis if you wanted to. I'll show you a site which also carries it every day. And then dividend yield. If you're an investor, most of the time it's older investors. So if you're an investor that likes to see dividends coming in on a regular basis, say quarterly, then you would be somebody that's very interested in that dividend yield. In fact, somebody who was in my office, I think it was my office, it may have been a class question, but I think it was in my office. They came in and asked a question about these dividend kings. That's a term that we use in the financial world. Those are companies that over the past, I think it's 50 years, have always given out a dividend. Pepsi is one of them. And so they were asking a question about how would they look at the dividend yield and how important is that to someone that's 20 years old. So we have some great discussions in my office. You guys can come in and ask me any questions like that. So that's where we're headed today. Again, I think when I talk about the solvency ratios, rather than bringing in some boring data from the book, we'll do the homework problem too. But I'm going to take a look at a company that I know all of you are familiar with to give you an idea of what these solvency ratios can tell you. And so in the chat area, and Eduardo or Eddie, sorry, can you go check that chat area? I put a link to Ford's financial statement. And so if anybody wants to follow along with me, Eddie, if you can make sure it works, that would be great. It should be some financial statements for Ford, and page 108 is the balance sheet. Once you get into that 10K, if you go to page 108, you will see the balance sheet that I'm going to be looking at. So here's Ford Motor Company.
I can't actually see anything in the chat. I don't believe you sent.
You don't think it's in there, huh? Okay, let me.
I saw it in the chat, Professor, and I actually, and I clicked
Oh.
on the link and it's there. And I'm actually on the page you're talking about, 108, so maybe
Okay,
everybody else can see it.
Awesome. Eddie, try one more time. And if you can't find it, I know that you know how to go research where that is. So you can take the long way home if that doesn't work, but try it one more time. And I have Ford Motor Company up here. Ford Motor Company has sparked my interest because the price is really low right now. And they have made an incredible investment into the electric vehicles. And I've seen a lot of good things about the research and development that they've been doing. I've seen some really good things with Tesla sharing information with Ford. And so again, I'm not giving you investment advice. I'm not telling anyone to go out and buy Ford. But because I've been looking at the stock hard the past, 6 months or so, I just thought I would use this one for these ratios that we're going to be talking about. So the first two that we're going to be talking about is the debt ratio and the equity ratio. Okay, the debt ratio and the equity ratio. And the first thing I want to tell you is that the two of these always have to equal 100%. And the other thing I want to explain to you is, when we did that vertical analysis where we took everything and we showed it as a percentage of assets, right? That was that vertical analysis. We took every line item on the financial statement in the demo data, and we showed everything as a percentage of a base. The base on the balance sheet is total assets. So here's what I want to show you with Ford or any other company. If I figure out how much the total debt is as a percentage of total assets, and then I figure out how much the total equity is as a percentage of assets, they got to add up to 100. They got to add up to 100%. And it makes sense that the more equity a company has, the safer the company is, right? High debt, if there's a high debt ratio, high debt means they got to pay the creditors off before they're ever going to give you anything. And remember that when we have debt, interest is mandatory. You don't have I'll pay it off if I feel like it. Just like you guys know, when you take on debt, you have to make those payments. Whereas if you are talking about equity from or contributions from a shareholder, you don't have to pay dividends. Those are always optional. You do not have to pay them. And so that's why, as an investor, we like to see more equity than debt, hopefully. Now, a company that is heavy into research and development, like Ford is right now, has to fund that research somehow. So let's see what happens. We got a balance sheet right here. So here's what we're going to do first. We're going to calculate what is the debt ratio. What in the heck does that mean? What percentage of their assets is financed by debt? And then the opposite of that will be, what is their equity percentage? What percentage of their assets are financed by shareholders? So I'm just going to bring a little Excel spreadsheet up in the middle of this so that I can show my calculations. In fact, let me move this up. So you guys have access to Excel, or you can just use your calculator. So right now we're going to do two things. We're going to calculate the debt ratio, and we're going to calculate the equity ratio. And at all times, these have to add up to 100%. So we're going to use a real life company. We're going to do Ford. And then if you wanted to, outside of class, you might go do a competitor. Okay, well, I've been really interested in GM for the same reason. They're heavily invested into the electronic vehicles, and they're also heavily invested into these auto-piloting cars. And so both, I think, are going to probably go up. I've calculated a lot of ratios for these two companies. I just bought Ford when it crashed yesterday or 2 days ago. I can't remember, a couple days ago. And so let's see what this looks like. What is the total debt for Ford? Well, here we are. We're looking at a balance sheet, and I need to move your pictures out of the way. Give me 1 second. Here's 2020 on the right. Here is 2019 on the left-hand column. I'm going to use 2020. And if I scroll down, and I might need to move this, you guys might need to move our pictures out of the way. You do that by just grabbing the top bar of the pictures of the people that are in the class and just moving it out of the way. All right, so here's the total liabilities right here. And these are in millions, which you'll see at the top of that balance sheet, but it's 236,450. So let me pop that in, 236,450. I'm going to make these numbers a little bit easier to read by, let me make this bigger and then I'll make it smaller, by using a comma format. I don't think I need the, we'll leave the decimal places in. And remember what the debt ratio shows us. Here's what we're doing. Whoops. Give me 1 second. What we're doing on the debt ratio is we're taking total liabilities and dividing by total assets, just like we would do on a vertical analysis. So when I try and remember these ratios, because I don't usually have tables in front of me, I think of a vertical analysis. And I know that a vertical analysis has every number divided by total assets. Excuse me. So I asked myself, what would I see on the debt side? And then the opposite of that, what would I see on the equity side? So here's what we're after. There's my formulas. I'm going to make this smaller once I give you guys a chance to write those formulas down. Then I'll make it smaller so I can go back and see the actual financial statement. I'm going to put another column in here so I can show you the calculation. And let me make this smaller. Okay, so let me minimize this again. My total liabilities for Ford, I put in there. And my total assets for Ford would be right here. 267, 261, 267, 261. I'm going to divide those two. And when you do that on your calculator, when I take the total debt and I divide by those total assets, the debt ratio for Ford right now, there's two ways you can read this. You can either read it as a percentage. I'll put at least one decimal place on there. Or the other way you can read it is like this, 0.89, I'll round it to 1. Okay, now what the heck does that mean? Okay, what that means is the debt percentage for Ford means that about 89% of their assets are financed by debt. Okay, they have quite a bit of debt. You should be able to tell me right off the bat what the equity percentage is going to be. Because remember what I told you, the two need to add up to 100%, because a company's capital structure is comprised of two things, debt and equity. High debt means they're going to be paying interest off for a while. Higher equity means, okay, there's not as much debt. It's owned by the vast majority of the money is being supplied by shareholders who, although if it's nice, you could pay them dividends, you don't have to. Okay, so I'm going to prove this to you in your head right now. If this is about 88.5%, what's 100 minus 88.5? This is going to be, what is that in my head? 11.5% or so when we calculate it. But let's go check it out. So I'm going to make this small again. And now I'm interested. Oops, where did it go? Now I'm interested in Ford's total equity. Okay, so I'm going to go down to the bottom of my audited balance sheet. And here's the total equity line in blue. It's 33,230. 33,230 is what I'm going to put in. And of course, total assets is going to be the same. So I'm going to go grab that same asset number I used above.
Professor,
And
I'm sorry to interrupt. Which year are we working with? 2019 or 2020?
Thank you. You are right. I picked up the wrong equity. I'm going to work with the more recent year. So you're right, Neff. I should have picked up 30,811. Remember, these are in millions. Thank you for pointing that out. You know what? How would I have caught myself on that?
The sum would not have added up to 100%.
Exactly. So on a test, take a moment to calculate the equity ratio and the debt ratio and make sure they add up to 100%. That is a way that you can catch yourself. So let's go back and let me make this bigger so we can see what we're doing. Let's go divide those two out. Format it as a percentage again. And when we add those two up, we got to come up with 100%. So get that into your notes. These two will always total 100%. Why? This all goes back to the fundamental accounting equation. Assets equals liabilities plus equity, right? If we're taking everything as a percentage of assets, the left-hand side, the assets is 100%, and the liability and equity is 100%. So if I was trying to determine, am I interested? Do I want to put my money with Ford or with GM? Do I want to split it up? I'd go calculate some ratios. All the ratios that we're talking about today, I would go calculate them. In the Excel class, you learn to automate this. You download some templates and you learn to automatically compute these. If anyone's interested in taking that class, I would highly recommend it. Questions on that?
Professor, I'm sorry, go ahead, Danya.
So 88% of their assets is being financed?
By debt, right? By
By debt.
creditors,
Okay.
yes. And the other 11.5% has been financed with contributions from shareholders who, although they are looking for some kind of a return on their investment, unlike debt, you don't legally have to pay back. You don't have to pay dividends, right? You don't have to repay your shareholders. They're in it for the long term. We're looking at solvency ratio. So I will tell you that that debt is pretty high. And my guess is if you went and compared it to GM, it's probably higher than GM or other companies in the industry. So what would that tell me? Well, another ratio that I would be really interested in on them is this times interest earned ratio that we'll talk about in a minute. Questions on that debt and equity ratio. Okay, you gotta somehow find a logical way to remember these. Well, these two ratios to me are very logical because I think of a vertical analysis and I know that everything is shown as a percentage of assets. So if I go to a vertical analysis, this is what I would see for debt. This is what I would see for equity. So I have no trouble remembering those two ratios in my head. And this one may even be the easiest one out of the whole set because it's exactly what it says. Debt to equity. It means that we're going to be looking at total debt on top, which we measure by total liabilities, and total equity on the bottom. Okay, well, I think we have those numbers in front of us that we grabbed from Ford's statement already. So total liabilities I used in the first one. Let me go grab it. And total equity I used in the second one. Let me go grab it. Let me pop that into our calculator and see what the result is. And And the easiest way to read this, is 7.67 to 1. Like many ratios, sometimes they're best understood if you read them as 2:1. So let me show you what this means. For every dollar contributed by shareholders, and you'll see me abbreviate shareholders a lot in this class as SH, so I'm going to put it in there right now as SH. For every dollar contributed by shareholders, the company owes $7.67 in debt. Right? Well, again, pretty high debt level. I have in the back of my mind that Ford is safe for a variety of reasons. Past history, definitely. The company's so big that the government has bailed them out in the past if they do default. The research and development costs are solid with solid companies. I read about these on some of the financial websites I go to. And so Ford's stock price took a dive. And I'm telling you guys all the time, you may not think that you can afford to invest in the stock market, but Ford has a very low price right now. We'll go take a look in a second, but those are some solvency measures. Not all of them, but some of them. So let's go take a look. Let's go see how much Ford is selling for today. So I'm going to leave this spreadsheet and I'm going to go to Yahoo Finance, which you guys can Google. You just put Yahoo Finance and it'll come up. Their ticker symbol is F. Ford, their ticker symbol is F. And right now today, if you wanted to buy 1 share of Ford, and you could start an account and you could buy 1 share if you wanted, or maybe you could afford to buy 10 shares and spend $126, whatever that comes out to. You could afford to buy 1 share. And I would be looking up a whole lot of other ratios. I would take a look at this PE ratio because that is key. We'll be talking about that in market prospects. But right now, 1 share of Ford stock is $12.70. A couple days ago, it was less than that. These charts tell you a lot on these sites, right? I can go look at a 1-day chart, which I think is what this is showing. I could go look at a 5-day chart and you can see what happened just this week. That's when the stock took a dive. I could go in and look at the past 5 years. What has Ford done? And I would encourage you guys to take a look at this. Most of the ratios that we're going to be talking about can be found in this site. However, let me warn you that the financial data is not always accurate in this financials tab. So rather than looking and relying on financial data on Yahoo's income statement and balance sheet, go to the source like we did. Go to the audited 10K because the auditors have opined or given their opinion on those financial statements. And by the way, you'll notice that the experts that feed this site also look at Ford as being undervalued, right? That's what I'm looking for. I'm looking for undervalued stocks that are going to take off. And just to give you some perspective, let's go put GM in here. GM's ticker symbol is GM for General Motors. 1 share of stock of GM is $49. The experts think this is also undervalued. Okay, and again, I choose to tell you just because you guys are my classmates. I don't mind sharing my failures either. I'm an open book pretty much. General Motors is another recent investment for me, also because of the electronic vehicle technology and the self-driving car technology that's out there right now. So if I only had money to buy 1, I would go through a series of ratios at a bare minimum, the ones that we're talking about. And then as you educate yourself more on the stock market, you could look at other opportunities out there. But most of us think that, I can't invest in stock. I don't have the money. Most of us could find the $12 for Ford, right? For me, it'd be giving up Starbucks for a couple days. And I haven't had a Starbucks in quite a while. I'm going through withdrawal symptoms right now. But most of us can find that money if we Let's take a look at some solvency measures by completing some exercises together. This exercise will give us some practice with solving solvency measures. The author's way of interpreting it is we're going to take a look at analyzing risk and capital structure. So in this problem, they give us a balance sheet, they give us an income statement, and they've asked us to analyze 4 ratios in total. The first one is going to ask us to analyze the debt ratio. Once again, this will ask the question, how much of their assets is financed by debt or with creditors' money? The equity ratio is the opposite. It answers the question, what percentage of assets are financed with shareholder equity? The requirement number 2 asks you for debt to equity. That's exactly what it says. That may be the easiest formula on here. And then the one that gives me the most trouble remembering, times interest earned. So I've set up a format that I would suggest that you use in studying for your exam. I would write the formula down in words for every single homework problem that you do. And then off to the right, I would write the formula in dollars, taking the information from the financial statements given. And then I would ask yourself, what does it measure and what does the result mean? I would ask you to pause the video, go back and first write in the formulas, and then go compute them and ask yourself, what does this measure? The debt ratio jumped from 39.7% in the prior year up to over 43% in the current year. This means that the debt ratio increased a bit by about 4%. This means that the company overall relied a little bit more on debt this year, which may cause the company to be viewed a bit more risky for shareholders. Moving on to the equity ratio, these will always move in the opposite direction. The equity ratio dropped from 60.3% in the prior year to 56.3% in the current year. Since creditors had a larger share of the asset pool, that makes sense that the equity or the shareholders percentage would have gone the opposite way. Don't forget to double check. Always double check. Does the debt ratio plus the equity ratio equal 100%? We're looking at the structure of the company's financial balance sheet. Always check that equality. Moving on, the debt to equity ratio takes debt on the top and equity on the bottom, jumped from 0.66 to 0.78. Because the debt increased more than the equity, the debt to equity ratio increased. We would expect that to happen. And finally, the last one, which gives me the problem remembering how to do it, measures how many times the company has earned its interest back. So it jumped from 3.9 in the previous year to 4.4 times per year. And the fact that that went up actually makes the company appear less risky for creditors. When a company has a greater ability to pay its interest, that is usually a good thing. How'd you do? If you have any questions, make sure you pass them along. Let's keep moving. Let's move from solvency measures to profitability and efficiency measures. The profit margin is a measure that you should be familiar with, and it takes net income on the top and net sales on the bottom, and it measures how much of each sales dollar is converted into profit. Another profitability measure that also measures the efficiency of asset utilization
is return on total assets. As you see on the screen, net income goes on the top and average total assets goes on the bottom. It's a measure of how well the company has utilized its assets. Often, profit margin and return on total assets are looked at together. In fact, we'll learn about the DuPont formula in another chapter. The return on common stockholders' equity measures a company's ability to generate net income for its common shareholders. You'll see once again, as in most profitability measures, net income goes on the top and average common equity goes on the bottom. If a company does have preferred dividends, sometimes they're subtracted out depending on the nature of the dividend. Let's practice these profitability and efficiency measures in this next exercise. On this exercise, your author asks you for 3 different ratios. First, the easier one that you should have learned in Accounting 100 and 101, profit margin ratio. A second, total asset turnover, which is a measure of efficiency. And the third, return on total assets. Pause the video, calculate the answers, and let's check our work. The profit margin has actually gone down over the prior year. It went from 5.5 in the previous year down to 4.6% in the current year. This means that a company is less profitable for every sales dollar and is an unfavorable sign. Moving on, when we take a look at how efficiently the company utilized its assets, we see that there was a slight increase of 1.3 to 1.4. This is usually viewed as a positive trend. The return on total assets measures the profitability generated from the invested assets. We see that this went down slightly. What this means is, although they were more efficient in their use of assets, as we saw in the measure above, they were less profitable per sales dollar. We'll take another look at a measure very similar to return on total assets in another chapter. Let's take a look at one more profitability measure before we go on and discuss market prospects. In this exercise, the author first asks us to compute return on equity, or how much profit is being earned for each shareholder. After that, we'll take a look at the market prospects, or forward-looking ratios, which both include a measure of the company's current price. Here is the solution to return on equity. Remember, the word return means net income goes on the top, and whenever a balance sheet item goes on the bottom with an income statement account, we need to always take the average. Be very careful calculating the denominator. Average total equity is shown in this formula. You take the common stock and retained earnings for 1 year, make sure that's in parentheses, common stock and retained earnings for the year immediately prior to that, make sure that's in parentheses, add the two together, that calculation is also in parentheses, and then divide by 2 to compute the average. This calculation brings some of the highest rates of error with students, so pay careful attention to it. The results show that in the prior year, the company generated 11.5% in profit for each shareholder, and in the current year, it dropped a bit. This means that for every $100 of shareholders' equity, the company generated, at least in the current year, $11.10 of profit. Down a bit from the previous year, That means that this trend is a bit unfavorable. The second part of this exercise uses what we call market prospect ratios. These are useful for analyzing corporations who are publicly traded. And you'll notice that in each one, the market price of the stock is considered. They are considered forward-looking ratios that analyzes whether a company has potential growth and whether a stock pays out decent dividends. The price-earnings ratio is one of the most heavily quoted ratios in all of Wall Street. As a matter of fact, it's published every day in the Wall Street Journal. It's a measure of growth potential and helps stockholders assess whether a stock is overvalued or not. We'll talk more about this when we get to the homework problem. As you see in the calculation, it's exactly what it says. The price of the stock goes on the top and the earnings per share goes on the bottom. The earnings per share can be a very complicated computation. Those of you that are accounting majors will spend a chapter or two on this topic later on in your academic journey. For now, know that earnings per share must be computed at the bottom of the audited income statement below net income. Finally, the dividend yield is used to compare the dividend-paying performance of different companies. It's computed as the annual cash dividends per share divided by the current market price. As we've spoken before, dividends are not always of primary importance to investors. If they are, and an investor is expecting to receive quarterly dividends, this would be an important measure for them to check out before investing. So in this exercise, go ahead and compute the price-earnings ratio as well as the dividend yield, and let's compare results. The results show us that in the previous year, the dividend yield was 0.9%, and it grew to 1% in the current year. Shareholders like to receive dividends in general, so this would be considered a favorable, in a favorable light. The price-earnings ratio is a measure of investors' expectations. We notice that is exactly what it says, price of the stock on the top and earnings per share on the bottom. In the previous year, investors had a 15.6 PE ratio. This means that one share of this stock was selling for 15.6 times what it was earning. You'll notice that grew to a rate of 15.8%. Increases in PE ratios are generally considered favorable. We could teach an entire chapter on the price-earnings ratio. I would encourage you to think about a couple of companies that you're interested in and use the Yahoo Finance or other website to check out the various price-earnings ratio. In fact, they vary widely by industry. Just for grins and giggles, why don't you go check out Tesla? I'd be curious to know what you think. This last problem is a good recap problem. It asks you to calculate various ratios. It's not all-encompassing. There are several market prospect ratios that are not included on this problem. But I would encourage you to use it as a final assessment on how well you understand the material in this chapter. There are several things I would do as I attempted this problem. I would write down which building block does it fall under. For example, the current ratio is a liquidity measure. I would write down the formula in words from memory. You won't have a handout to go check out on the exam. I would strongly encourage you to consider using flashcards in this chapter. On the front of the flashcard, I would write current ratio. On the back of the flashcard, I would write that it is a liquidity measure and that it's computed by taking the current assets divided by the current liabilities. I may also write down, if it has been mentioned, what a good benchmark would be. And then I would ask yourself, what does this tell me? What is it measuring? That would be a great way to prepare yourself for the upcoming test. In fact, I would use this as an overall assessment on whether you've mastered the materials. If you can get most of it right without much assistance, you are ready for the test. If you find yourself having to go back to the notes, or if you find yourself having to go back to see, how do I calculate this ratio, then you probably need to practice a bit more. I'm going to post the answer to this solution in another moment or two. You'll definitely want to pause the video and compare your results to mine. Here's the answer to the first 3 liquidity ratios. I'm going to give you a moment to look it over and possibly pause the video. As we move up, here's the answer to the next 3. 2 of them are a liquidity measure and 1 of them is a solvency measure. I'll keep scrolling. Here is the answer to the next 3. Let me move that up. And then finally, as we wrap this up, here's the answer to the last 2. Return on equity, that last one, is the one that causes people to make mistakes. So again, I would encourage you to work out that problem to assess whether you have a good understanding of the materials. Better yet, those of you that have an academic curiosity about what does all this mean, I would encourage you to research these on your own for a company of your choice. In fact, you may very well find out that the term project for the class will do exactly that. More about that later. This is Professor Johnson signing out.